Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include progressive changes we're seeing in the mortgage industry, my interview with Lenders One's Justin Demola on how originator compensation will evolve in the age of digital mortgage, and reaction to Fed Chair Powell's dovish speech Friday from Jackson Hole. Are you looking to grow your pipeline while making a real impact? Arrive Home helps mortgage lenders connect creditworthy buyers with down payment assistance and affordable homeownership solutions. With a mission to close the wealth gap and expand access to homeownership, Arrive Home offers tools that empower lenders and uplift communities. Visit arrivehome.org to learn how partnering with purpose can drive your business forward and help more families unlock the door to homeownership. I received a thesaurus in the mail today, but when I opened it, all the pages were blank. I have no words to describe how angry I am. Think of all the people in our business, or any business, that started in the mailroom, then changes afoot in mail delivery. First off, several European and Asian countries are cutting off delivering packages to the United States due to Trump administration tariff policies. Meanwhile, Denmark is ending letter deliveries in general. Lenders, title companies, and vendors will use the most cost-efficient, accurate, and reliable communication method they can. Along those lines, don't forget that MISMO is the standards development body for the mortgage industry and is the reason that a common language for exchanging information for the mortgage finance industry exists. Today, MISMO standards are accepted and deployed by every type of entity involved in creating mortgages, and they are required by most regulators, housing agencies, and the GSEs that participate in the industry. But just how are those mortgages performing? ICE Mortgage Technology's July 2025 First Look report reveals continued strength in U.S. mortgage performance despite a rise in foreclosures. The national delinquency rate fell to 3.27%, improving for the second straight month and remaining well below pre-pandemic levels. While serious delinquencies rose by 30,000 year over year, this marks the smallest annual increase since November, as the effects of past natural disasters diminish. FHA loans continue to show the most stress, accounting for 52% of serious delinquencies despite a slight monthly improvement. Foreclosure activity increased for the fifth straight month, but remains 35% below pre-pandemic norms, and prepayment activity saw a modest rise to 0.67%, up over 12% from last year. We are seeing some sort of cancel culture in mortgage, though. In July of this year, a record 58,000 home purchase contracts, which is 15% of all deals, were canceled, according to Redfin, as high prices, rising mortgage rates, and economic uncertainty caused more buyers to back out even after signing. Job security concerns are a key factor, with 44% of American workers citing it as a reason for delaying major purchases like homes or cars. A Redfin Ipsos survey found that nearly 40% of workers feel less secure in their jobs compared to 6 months ago, particularly those earning under $50,000 annually. Factors like company performance, tariffs, AI adoption, and a lack of emergency savings further fuel buyer hesitation. Cancellations were highest in Florida and Texas, where abundant new construction, high insurance costs, and rising HOA fees give buyers more options and more reasons to walk away. The housing market remains stuck in a state of stagnation, with last week's data showing only modest gains. Existing home sales rose 2.0% in July to a 4.0 million unit annual pace, roughly unchanged since January, while new home sales, despite a 5.2% month-over-month increase in June, are down 6% year-to-date, with permits falling 12%. Persistent affordability challenges driven by high home prices and mortgage rates continue to suppress demand, limiting the pace of both existing and new home sales. A weak summer buying season, marked by elevated borrowing costs and economic uncertainty, has led to a buildup of inventory, which is beginning to cap home price appreciation across many markets. Builder incentives, once effective in propping up new home sales, are losing traction, and the growing supply is yet to fully translate into improved buyer activity. Meanwhile, sellers remain sidelined, locked in by ultra-low mortgage rates and eroding liquidity, further constraining resale supply. Even with slight rate declines, the impact on affordability is muted, and until consumer confidence improves and borrowing costs meaningfully retreat, the housing sector is likely to remain a drag on broader economic momentum. For today's interview, I wanted to welcome to the show Lenders One's Justin Demola to talk about how originator compensation will evolve in the age of the digital mortgage. As president of Lenders One Cooperative, he leads its day-to-day operations and strategic execution. With nearly 30 years of mortgage, consulting, and business development experience, he joined the organization in 2019 as vice president, sales, and most recently served as managing director before becoming president.
When people hear compensation or the LO comp rule, I feel like there's some confusion, whether that is it's the actual salesperson cost versus overall comp cost. Can you kind of clear that? And this is us jumping into the interview here, but can you kind of clear up the LO comp rule versus originator compensation and kind of where there could be some ambiguity between those?
Oh, when you look at the definitions, it talks about, a loan originator. And when you look at the comp rule, and I think there's some question and deviations between, a direct retail versus a broker. And technically speaking, when you look at LO comp rules, if you're a broker, they say it's 3% for under Dodd-Frank, and most wholesalers will pay 2.75 as their max comp to have some cushion for additional expenses, and the loan officer gets some portion of that, right? When you look at direct retail IMBs, they're not capped at that 2.75 comp, but technically their loan officers are. So when you look at it, two different ways, there's an entity on one hand versus an individual on the other, if that makes sense to you.
It does make sense. I'm wondering what that kind of wiggle room has allowed for in terms of the way individuals are being compensated, because there's various schools of thought out there as we move into this kind of technological age for mortgage. And one would be, hey, for a lot of these vanilla loans that technology can handle, the costs of maybe an actual originator doesn't need to make 125 basis points or more on a loan. However, there's another school of thought that says, hey, with all these technologies out there, maybe we don't need underwriting or processing costs, and a good originator is worth their weight in gold. And you obviously originated loans for a long time, and that's why I think you have some gravitas to lend a good perspective to the situation. You're removed from it now. But when you think about compensation in the modern digital age in mortgage, what do you see as kind of the problems, and where do you see things trending toward?
Well, there's lots of issues in loan origination today, and everyone tries to solve them a different way. I do believe when you look at just pure costs, that the largest part of originating loan is a sales cost, and we can even lump it in sales and marketing, right? Because while certain people may be paying less in loan originator comp or sales costs, they still have marketing and advertising. So when the cost to acquire the customer, whether it's technology, advertising, humans, boots on the street, whatever it is, that's a large cost to originate a loan. And I think when we look at all the moves that the administration is trying to make, the FHFA is trying to make, the elephant in the room really becomes the origination piece of what it costs to originate a loan. And there's plenty of lenders that are talking about it behind closed doors, and they don't want to be the first one on the street to say, hey, we're going to lower our originators comp, because there'll be a mass exodus of originators from their organization to people that are paying more. But at the end of the day, I think even the best originators at the highest comp really need to look at a lot of different factors and how they can improve their business for the long term.
So do you view any solution here as incumbent upon like the Trump administration to issue some sort of decree capping it, or how do we get to a place where that sales cost potentially comes down? And go ahead.
Yeah, and I think there's a couple things that we should kind of put out there that are important, right? I think every successful salesperson should be able to have unlimited earnings. There's no question about that. However, what we see is a couple of things, right? The pull-through ratios of these originators that have higher comp buckets generally are greater. Have greater fallout. So, you have a loan officer that's making 150 to 175 basis points, 200 basis points, whatever the number is. Their pull-through ratio is not as strong as someone at a 100 basis point bucket. I do believe that is significant. We've spoken to plenty of IMB owners, big, small, and everywhere in between. And, the people that are generally in lower comp buckets close more loans, have an opportunity for additional referrals because they're touching more customers, and make just as much, if not more, than the people in the higher comp buckets. So, if I was an individual today looking at, where I wanted to be with my comp, I would go on the lower side, right? I think at the end of the day, if I can close loans consistently, close more loans consistently, that that network effect will continue to grow and expand on the compound side of this, right? One turns into two, turns into four, turns into eight, etc. That is immeasurable, and I think that's a better way to build a career instead of making some quick money.
But you got to the crux of the matter, and that is for seasoned quality originators that have a huge book of business and are incredibly efficient and maneuvering deals, or they have the process dialed in, or they're the best at what they do. Customers want to work with them. They're trusted advisors. The second that a company lowers what they say they're going to pay them, they'll jump ship to a different company, and so you get to this sort of Wild West scenario. And I'm trying to solve for that here with you. What it would take? Yeah.
I think there's short of the government coming in and saying the max the loan officer could make is X. I think it's very hard to put it into practice, right? I think you need to, if you were running a business today, you need to have open conversations with originators and be transparent and make it a joint decision, right? When someone believes in something, they're more likely to adopt it and grow with it. So I think it's open communications, with loan officers. Hey, we did an analysis of your pull through, and you had this many loans that you closed. This many loans fell out. From what we can tell, we lost these loans for competitive nature as opposed to denials. And even if you captured an additional 50% more of those at the lower comp overall, this is how much you would have made. And I think the numbers will tell a very unique story. At the end of the day, it's something that loan officers have to go into it with open eyes and say, hey, how can I build a better business? How can I get more referrals? How can I do more transactions? How can I be a better partner for my referral partners, right? By taking better care of their borrowers. And you're going to have certain demographic of loan officers that's going to come up and say, you know what, this is great. I want to do this. I'm all in. And you're going to have certain people that are saying, you know what, I still want to make my 150, 200 basis points alone, and it doesn't work for me. But I think the owners of these organizations shouldn't be afraid to have the conversations and start out by saying, let's make this a joint decision, or what do you think about this? It doesn't necessarily affect me per se, because my corporate margins are going to be the same. I'm trying to help you become more competitive and help the organization grow to the next level with more transactions.
Yes, you have a ton of members at L1, and you're in constant discussion with them. There's group roundtables. So you have a good finger on the pulse, or ear to the streets when it comes to these sort of things. When we look at the cost to originate a loan, you might say it's 10 grand or 12 grand or 13 grand, it could be whatever. Where do you, Justin Demola, president of L1, see that coming down? Is it through operational efficiency? Is it through sales comp? Obviously, we said that's the biggest part of it, but that might not be where we see the savings. Where do you see cost to originate?
Yeah, one other piece while we're talking about sales, and I think it's important to note, when you have a loan officer that's making $10, $12, $15,000 a loan, right? Because they're doing bigger loans or even on the smaller side, they're getting, a $500,000 loan, they're making $10,000. I think the quality of loans also goes down because they're going to may not pay attention to the things they're going to pay attention to, because at the end of the day, for them, it's a $10,000 check. And I think that's just human nature. I don't think there's any flaws in people. I want to believe that there are no nefarious loan officers out there, even though we know there are. But in general, I think there's more motivation to get loans closed when you're making more money, and some corners can be cut. So I think that's also important to note, because on the flip side, if that loan turns into a bad loan, whether it's fraud, it's a repurchase, whatever it is, it's additional cost on the institution that's originating that loan. So I think that's another really good, argument why LO comp should be looked at a little bit more closely.
Sure. And I like where you're going with the, hey, let's make this a joint decision. It's actually going to benefit my borrowers and benefit my book of business if there's a way we can kind of rejigger some of these things. But I don't necessarily, this is more for devil's advocate than anything else, I don't necessarily see those salespeople that want to continue making large amounts of comp on loans going by the wayside anytime soon. And so I'm kind of wondering how we get from point A to point B over time in a way that doesn't largely disrupt the industry.
I think you can do tests with them, right? Or do some A/B testing in your own organization. This subset of loan officers has this rate sheet or this comp, and this subset has this comp. Because you're gonna get certain people that want to try it, right? And do a test and see if you can close X amount of more loans. And obviously, our business is so dynamic and it changes, based upon the rate environment, and the demand for housing and home prices. There's so many external macroeconomic factors that affect our business. But if you can kind of look at it during the same time period as an A/B test and say, okay, this person closed this many loans, their pull through is this. This person closed this many loans, their pull through is this. This was their total income versus your total income, right? And you can kind of do a little bit of an internal study. I think it's invaluable. At least you know where you stand and what makes sense. And the numbers may not be indicative. I mean, a quarter point is probably not going to make much of a difference. But if you have someone between 100 basis points and 150 to 200 basis points, you're going to see significant, reductions in interest rate, and I believe more customers coming to your door.
Okay, I do want to transition subjects here slightly.
Yep.
As I alluded, you have a tremendous amount of members, and you're constantly talking to them. What's top of mind for companies right now? And you could get some low-hanging fruit in terms of what's the administration going to do with Fannie and Freddie, those sorts of things. But what do you feel like your members are focused on in terms of winning business and adopting technology in ways that maximize ROI? What are the most successful companies right now doing?
We could talk forever on this, right? Because I think everyone is doing something differently, and people are finding success in many different things. So, when we get everyone in a room today, they all want more business, right? How do you get more business through the door? What's a way to get in front of the customer faster? Is it technology? Is it monitoring your servicing book, right? Obviously, our some of our members are not as sophisticated as some of these, mega servicers. So, if they have a small book of, $10 billion or less, or whatever the number is. And, we were in a room a couple of weeks ago with some members, and, we had a member that has about 15,000 loans in their servicing portfolio, and they're not monitoring them at all. They're waiting until a loan gets to a payoff to try to recapture that. It's not best business practice. So, we gave them some tips and tricks on what to do there. But ultimately, everybody wants more loans to close and to originate more loans on a daily, monthly, annually basis today. That's the easy one, right? That's the top line. But when you really start digging in, you got to look at costs. And there's been a lot of scrutiny on credit report costs, or verification costs. I go back to a couple of things on that. The first being, you need the verifications for a bunch of different reasons. And the first one really is, to protect against fraud. I think, if you can originate cleaner loans, it brings costs down overall for the industry as well as your organization. Secondly, if you're doing day one certainty or AIM products, you're going to close loans faster, right? And you're going to have less reps and warrants. You're going to have a better customer experience throughout the process, and you're going to get more referrals. So I think those things, while they may be expensive, per drink, they create tremendous value for the organizations across the board. Then now you're looking at credit report costs. While we all know, they have gone up, they're still a tiny percentage of the overall closing costs.
Yeah.
And one of the things that I'll say over and over and over again, whether it's VantageScore or it's a single repository, yeah, I think we could all underwrite loans that way. But people that are measuring the risk and that are purchasing these securities are not going to be too comfortable with a change. This is the first thing in my world that I'll ever say we've done it forever. We might as well continue to do it forever, as opposed to, hey, this is the way it's always been done and we should fix it. When you look at the measuring of risk, I don't think there's enough data that we can run in parallel to understand what a risk would be by changing this significantly without affecting the interest rates. I believe that there'll be LLPAs or there'll be risk attributes that, whether it's the mortgage insurance companies or the MBS purchasers, that are going to say, hey, we're just not 100% comfortable with this, and we're going to err on the side of caution, which means that the rates are going to go up and the borrowers are going to pay more in the long run. So I think we can get there, but I don't think it's a 3-year project. I think it's a 5 to 7-year project, really running the data side by side.
Yeah. And I appreciate you bringing some credibility to this, because L1 does save lenders on credit costs, but shout out to you for saying it is a small percentage of the overall cost when we think about things. But I do want to give you an opportunity to talk about the value prop of Lenders One before I let you go here. And what is the value in joining collaborative or cooperative or group of lenders out there?
One of the first things I will say to anyone when they talk about or they ask about value for what we do and what we offer is every single distinct member finds different value in any of the things that we provide. And what's great for one lender is not great for another. While I can throw out statistics today and say, you know what, we have a Lenders One credit member that we saved $1 million a year with, right, from switching from their existing provider to us. We have another one that's in the process of hopefully switching, $3.5 million a year. But on average, we're saving 15 to 20% for credit report bills. That's an easy ROI, right? When you look at the cost of membership, which is minimal, I mean, the average member pays $5,000 a year to be a member. We don't make money on membership fees whatsoever, but we have so many different verticals and different revenue generating sources. That's where we make our money. So credit is a common denominator across most of our members that are looking to join or have joined. They're between credit and verifications and 4506, SSV, all those products, we are offering them at lower prices than our competition while maintaining great customer service. And I think that's really important. But that's the common denominator. But then you go into all the other products and services that we offer. Some people come on because they want the free continuing education for their loan officers. Some people come on because they want the discount to an LOS or another technology provider that's on the platform. So everyone finds a different need, and it really depends on. I always joke around with the sales team. I'm like, you could have a member that has a need to solve 10 challenges, and there's 10 opportunities to generate revenue with them. However, the timing is only right for one of them. So you just got to keep, working with them and consulting to them about, how they can implement the first one and then the second one or the third one, whatever it is. But there are so many different ways for ROI. We really have to pay attention to making sure that we get things across the finish line with members. While also saying about ROI is the members have to be engaged. The members aren't engaged and they just sit back. Like the money doesn't, the savings and the efficiencies and the best practices just don't pop up in the middle of the night. They need to be engaged. They need to work with our sales team. They need to come to events, talk to our providers, because that's how we're seeing the members really, really, really get the most ROI out of the membership, and it's significant. I mean, at the end of the day, if it's $5,000 to be a member, and you're saving $3.5 million, $1 million, or even $200,000, the ROI is very significant. And then the last piece of it is really, sitting in a room with your peers without any inhibitions, and everyone's talking about their businesses and what's working and what's not working. Like we just spoke about LL Comp, getting what your competitor is doing inside their four walls is really valuable. The information flows very freely. People want to help each other. There's a sense of community and camaraderie. So, coming to the events, people absolutely love coming and learning and understanding what's going on in the industry, at a global level, and then at a micro level inside of others' organizations.
Yes. And as I said to you before, I'm amazed that I hadn't had you on until this point. I think it was certainly a very substantive discussion. I'm very pleased you made the time, and hopefully this is the first of many on here. So thank you very much, sir.
Yeah, of course.
Federal Reserve Chair Jerome Powell's latest remarks sparked a significant market reaction, with the odds of a September rate cut jumping from 72% to nearly 90% following his comments on Friday from Jackson Hole. Markets were initially bracing for a continued hawkish tone, but Powell surprised by emphasizing rising downside risks to employment and suggesting that these risks could materialize quickly, prompting a shift in policy stance. He described the labor market as being in a curious kind of balance, citing recently revised weaker job growth data. While acknowledging the threat posed by inflation, Powell struck a notably dovish tone, balancing inflation concerns with growing signs of labor market fragility. In a broader context, he used the opportunity to unveil updates to the Fed's long-term monetary policy framework, revisiting key elements first revised in 2020. These changes include dropping language that suggests tolerance for shortfalls in employment and replacing it with a more flexible view that employment can exceed real-time assessments without necessarily risking price stability. The Fed also scrapped its pandemic-era approach to tolerating above-target inflation to compensate for earlier shortfalls, signaling a return to more traditional inflation management. While still reaffirming the 2% inflation target, Powell emphasized a cautious approach, noting that the Fed's current restrictive stance allows room to respond if economic risks shift further. Markets responded enthusiastically to Powell's shift in tone, with equities rallying, treasury yields falling, and the dollar weakening. The dovish pivot, framed around a challenging situation of opposing risks, was seen as opening the door to rate cuts as early as next month. Powell emphasized that the current policy rate is significantly closer to neutral than it was a year ago, and reiterated that maintaining anchored inflation expectations remains essential. The Fed chair received a standing ovation following the speech, and while more commentary is expected from other Fed officials, Powell's remarks have set a constructive tone likely to carry through upcoming policy discussions. This month-end week ahead of the long Labor Day holiday weekend includes economic updates on the housing market, Fed surveys, Q2 GDP before PCE and Michigan sentiment on Friday. Treasury will auction month-end supply tomorrow through Thursday, and several Fed speakers are currently scheduled. Today's economic calendar kicked off with the Chicago Fed National Activity Index for August, which declined to 0.79 from plus 2.54 in July. Two of the four broad categories of indicators used to construct the index made positive contributions in August, but all four categories decreased from July. The index suggests slower but still above average growth. Later today brings new home sales for July, Dallas Fed Texas manufacturing for August, some short-duration Treasury auctions, and remarks from Dallas Fed President Logan and New York Fed President Williams. We begin the week with agency MBS prices slightly worse from Friday's close, the 2-year yielding 3.73% and the 10-year yielding 4.29% after closing last week at 4.26%, down 7 basis points over the course of last week. Let's wrap up with a joke and some housekeeping. There was a man who worked for the post office whose job was to process all the mail with illegible addresses. One day a letter came addressed in shaky handwriting to God, with no actual address. He thought he should open it to see what it was about. The letter read, "Dear God, I'm an 83-year-old widow, living on a very small pension. Yesterday someone stole my purse. It had $100 in it, which was all the money I had until my next pension payment. Next Sunday is Christmas, and I've invited 2 of my friends over for dinner. Without that money, I have nothing to buy food with, I have no family to turn to, and you're my only hope. Can you please help me? Sincerely, Edna. The postal worker was touched. He showed the letter to all the other workers. Each one dug into his or her wallet and came up with a few bucks. By the time he made the rounds, he had collected $96, which they put into an envelope and sent to the woman. The rest of the day, all the workers felt a warm glow thinking of Edna and the dinner she'd be able to share with her friends. Christmas came and went, and a few days later, another letter came from the same old lady to God. All the workers gathered around while the letter was opened. It read, "Dear God, how can I ever thank you enough for what you did for me? Because of your gift of love, I was able to fix a glorious dinner for my friends. We had a very nice day, and I told my friends about your wonderful gift. By the way, there was $4 missing. I think it might have been those bastards at the post office. Sincerely, Edna." FHA fallout borrowers represent untapped market share that can stabilize your shrinking pipeline. Arrive Homes' earned equity program supports these clients on their path to meaningful homeownership. Additionally, FHA borrowers who don't have the benefit of family assistance are able to qualify using the nation's leader in GPA. For more information, visit arrivehome.org.